Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Skarica, founder of Addicted to Profits newsletter online at addictedtoprofits.net. He also writes for the Financial Intelligence Report. Welcome back to the show, David.
Thanks for having me.
David, the markets, as we speak, it's another red letter day where they're bleeding red ink. Is this the pattern we're going to see? A couple of days where they charge like gangbusters, and then for the next couple of days after that, it's some major steps down?
Yeah. Actually, I think my opinion is that this was a bear market rally. That it was a little bigger than some of the past bear market rallies, and it's probably because of all the liquidity that they threw into the market. But if you go look at the charts, just from a charting standpoint, it looks very similar to actually the spring rallies, which happened in the Nikkei in 1990. For those who aren't aware, the Nikkei had a huge bubble at the end of the decade, kind of like we had. And then there was a quick, like about 30 to 35% sell-off, kind of like we had. And then there was a rally that kind of lasted from about April, May into the summer. And then the market actually began to roll over in July and then really sold off in the fall. I think that's what's happening now. So probably the majority of the bear market rally is now finished, and it has been led by very few stocks. Some stocks have just bounced off lows, and then other stocks that are benefiting from social distancing or quarantine or lockdowns or whatever you want to call it, they've kind of taken off and are trading at ridiculous valuations. I'll get more into that in a second. But the actual averages itself, I would think that, roughly 3,000 on the S&P is going to be your kind of overhead limit, and then you'll kind of be churning sideways for a few months. And I think, right now I think there's a lot of false hope going on. I believe that at best this is a W-shaped recovery, and at worst, and more probable, is an L-shaped. Because people are like, when they talk about, things are opening up. Well, you're opening up, you're wearing masks in restaurants, and the restaurants only have a quarter of the people in there, and you got to look at what you're going to have to go through to just, jump on a plane now. It's not like really opening up. It's just opening up in this quote-unquote new world. And I think there's going to be major problems with that. And if you're like, say, a small business owner or any business, if you're like a casino or something, at some point what's going to happen is when your kind of bailout money runs out and you have to keep people on for a certain amount of time, you're probably going to rehire a quarter of the people that used to hire if you don't go out of business altogether. So I think that's the issue right now. I think there's this thing where, like, when you think about the average person, I'm someone who has kind of studied these, history and markets and all this sort of thing. It's like you kind of know about past depressions, recessions, pandemics, how things act. The average person just kind of thinks, we're just going to be hunkered down and locked down for 4 months, then everything's going to kind of come back. And I think that is, really incorrect. The perfect example is this, to not even talk about markets, but just, it's a nice little microcosm, is in football. We were talking off air right before we started. I'm a big football fan. I'm a big Raiders fan. They got the new stadium in Las Vegas, and supposedly those are like the most in-demand tickets. But those people buying those tickets are idiots, in my opinion, because they're not looking at, there's probably still going to be social distancing in the fall. Only a few thousand fans are going to be allowed probably into those games. And traveling to Vegas is just going to be so onerous. There's going to be less flights that are more expensive. And then all the things you're going to have to go through, like in terms of testing and wearing masks. People just aren't going to go there en masse, but it's like the people buying them are probably just kind of meathead football fans who want to believe things are just going to turn around and be normal in a few months. And I think when people awaken to the fact that it's not going to be normal, that's when you're going to kind of see the next leg down in the markets. And then if you look at the markets themselves, just to expand on the point I made earlier, there's this chart that shows like the top 5 or 6 stocks market cap wise and what percentage of the market they are. And right now it's bigger than it's ever been. And the last time this happened was 2000, when you had Cisco and AOL and, Amazon, things of that nature, Nortel, et cetera, those big telecom and internet stocks back then were, they were all the ones really just running up, and a lot of the market actually didn't run up in 99, 2000. Well, now you've got, the Netflixes, the Amazons, the Walmarts, things of this nature that are basically benefiting from people having to stay home, having to order things online, having to sit and watch things online instead of go to a movie or the whatnot. These things are all benefiting, and all the money is kind of moving into those. Zoom would be another, and their market caps and their valuations are ridiculous. Like, for example, Zoom has a bigger market cap than the entire airline industry combined. So it's just like these things. I think that will last, for another couple months as people kind of move into those stocks. And then what I think is even in the fall, I don't even think it matters if it's a second surge of cases in the fall or not. I just think in the fall it's time to wake up and be realistic and realize, hey, this is an L recovery. This is not, a V recovery.
What kind of an investment strategy should you have then if it looks like an L recovery instead of a V or a W?
Well, number one, I just think you need to, an L recovery probably means in the short term, the next 6 to 12, 18 months, we will still have a period of deflation. Because remember, one thing that hasn't happened yet is people are getting their bailout checks or stimulus checks or what you want to call it, is they still have enough money to stay alive, right? They can maybe make their mortgage payment, etc. But I think at some point people have to start to liquidate to raise funds. Maybe I'll sell that second car. Maybe I'll sell that second house. Maybe I'll sell my first house because I just, it's just too close to the cuff in terms of being able to make this mortgage payment. And I think that will really hurt asset prices, which is, of course, deflationary. And I think that's kind of the next wave. So I think you want to keep a lot of cash. That's kind of boring, but because you want to take advantage of sectors when they actually do get cheap enough to buy. And I think because they're fighting this about printed money, you still want to own your precious metals. Now, maybe some of those precious metal stocks will get taken down with that kind of sell-off in the third and fourth quarter, but I have kind of a core position that I'm not interested in selling and that I would add to if they did get taken down a bit. And I think at some point, the whole deflation-inflation argument is also not black and white. The deflationists just think, all prices are, a guy like, I don't know, I don't want to out names, but like Mish Shedlock, he thinks everything's going down in price. Where guys like Peter Schiff, he thinks everything's going up in price. I'm kind of in between. I think we're going to have supply chain disruptions. We're already seeing that in meat and poultry prices. And when people start moving production away from China, that is going to disrupt things and make prices higher, especially if some more tariffs come on China as a reaction to all this. So you have inflation in some fronts, and then things like I said, car prices, housing prices, those things will probably be in a deflationary kind of mode. And then the amount of corporate debt out there is also kind of deflationary because companies are going to do whatever they can to try to service that debt, and there could be real issues with it. So I think we're going to have this kind of mixture of deflation in some areas, inflation in some areas. But I think when you get through that, and I think it'll be, like I said, a 12 to 18 month time frame, so basically by the end of next year, at the latest, I think the reaction is going to be so fierce. Whatever, MMT, modern monetary theory, universal basic income, whatever they can to keep consumers afloat, it will end up being inflationary in the end. And one thing people on the deflation side aren't taking into account, in my opinion, is because the U.S. is the reserve currency and they can borrow so cheaply, they're being much more aggressive than any country in the world, even Canada, even Europe, in terms of doing these bailouts. Like their deficit, like I read an article recently talking about how it's horrible, like the Spanish deficit is going to be 10% of GDP and how this is like, some huge thing. I'm like, the U.S. deficit's going to be 30% of GDP. So like they're, I think at some point that will affect the dollar, maybe again, with this deflationary trade, maybe not in the short term, but I think you also have to be prepared for that. And I've always thought that, by the way, if you go look at even, the Weimar Republic in Germany, the initial bust was deflationary. And, because, the economy was collapsing because of all the debt repayment. And then when they printed, the end result was hyperinflation. So that's actually what happens with hyperinflation. The first 12 to 18, 24 months can actually be deflationary because of the bust. And then afterwards, is when you see the losing in your purchasing power. And by the way, last thing with the gold miners, one thing that no one's taking into account, or virtually no one, that really helps them in their bottom lines is, and I can't believe no one's talking about this, is that these collapse in oil prices, that really helps them because a huge input cost for gold miners is energy. You know, like oil and gas to, you know, run the mines, run the machines, you know, the cars, the trucks, etc., that work the mines, and that is really going to help them. And then also on top of that, there's going to be no wage pressure because with the economy so bad, miners aren't exactly going to try to strike right now. They're just going to be happy to have a job.
We'll have more with David Skarica right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with David Skarica. David, the head of the U.S. Fed, Jerome Powell, said today he is not contemplating negative interest rates. Is that good news for the banks, or are zero interest rates, or in Canada 0.25, still not enough for banks, insurance companies, and pension funds to make any money?
I think it's still not great for the banks, but I am glad that he's not taking that route because I really believe that negative interest rates, especially with all the debt, I think one difference that we have in the system would be very detrimental to the United States banking system. Like one difference between negative rates in the Europe and the States is that negative rates in Europe, by the way, didn't work. But the thing about that was different is the European banking system in terms of the amount of consumer debt out there. If you go look at Italy, for example, Italy in the G12, is actually one of the least indebted consumer countries in the Western world. I don't mean, the government debt in Italy is high, but actually the consumer debt in Italy is very low as a percentage of GDP. So the thing about it is, the problem with negative interest rates in the States is, and Canada, is that consumer debt is so much higher in North America than a lot of other parts of the Western world. I think having those negative interest rates and basically paying people, to borrow money from the bank would just decimate the banking sector. So as much slack as I give the Fed, as many people give the Fed, I really think they got to hold to just not, doing these negative rates because I do believe those negative rates would just decimate the banking system with the amount of consumer debt we have. And we have much more of a consumer debt-based society in North America than even in Western Europe.
For the insurance companies, we're hearing about strata councils all over British Columbia getting into financial trouble because they're boosting their insurance premiums by 200-400%, I think simply because they're not making any interest on the deposit from their clients.
Yeah, like actually one of the advantages I have living in the Bahamas is because the Bahamas is only like B-rated in their debt. It's actually one of the few places in the world you can still get a real interest rate. Like if you set up a Bahamian dollar savings account here, you get 4 or 5%. You buy a government of the Bahamas bond, you probably get like 7%. So the insurance companies here, even after Dorian, which was this monster, hurricane which destroyed one of the islands here, Abaco, they're actually, I was actually shocked that all these insurance companies that stayed solvent. And I think part of the reason is they're getting, real rates of interest, of return, on their investments. So, anyway, I'm just using that example. But yeah, the problem now you're going to have in the States or Canada is those premiums are going to have to go up at a time when people aren't working because the interest rates are so low and the insurance companies can't make anything, right? So I think you're going to see that be very detrimental, and people are just going to say at some point, you know what, I'm going to take my chance not having house insurance or I guess you have to have car insurance if you have a car, right? Or people might say, hey, I'm going to sell my car because the economy's crap. I'm not driving anywhere anyhow, you know? So I'll take an Uber, you know? Or a cab or whatever, you know? And I think that's something to look at as well. If those premiums really start going higher due to the lack of return of interest rates. And by the way, one thing that's never factored in these zero rates or negative rates, look at Japan, right? Japan is about 10 years ahead of us demographically. They have an older population, and their bus started, our bus started really in 2000 with the dot-com bus, and Japan started in 1990. So they're about 10 years ahead of us, I feel. And what happened in Japan was, they have such an old population. A lot of those old people live off interest on bank accounts, on savings accounts, etc. So what ends up going on, right? What ends up going on is you got to live off that interest. So all of a sudden, if you're 70 years old and rates go from 5% to 0, it actually hurts the economy because the 70-year-old that say has $1 million in the bank, that 5%, he was making $50,000 a year and spend that on whatever, go vacations, traveling, going to restaurants. Well, now that $50,000 is 0. So I think that's one thing they never take into account is the demographics. And if the population is older and you're cutting rates to 0, these old people who live off fixed incomes and fixed interest, they're actually going to spend less because they're not getting anything on their money. And it may force them to do stupid things like speculate in the stock market, which is overvalued, just so they can get a return or they can get some dividends or something like that,
Well, people should be aware in Japan, they sell more incontinence diapers than they do baby diapers. That's how old the population is.
Yeah, and they have a declining rate of population as well. And I think that's one thing that no one's ever taken into account in Japan is that people look at those interest rates being 0 for 20 plus years and never take into account that, hey, maybe one reason that Japan has never recovered is because they have all these old people who, again, live off fixed assets, live off fixed income, live off fixed interest, and they've had 0 interest for 20 years, so those people just really aren't spending.
We'll have more with David Skarica right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with David Skarica. David, something that you found out is in Toronto, a lot of people have second homes and they were relying on Airbnb to pay for the mortgages on those second homes. Well, now, without any travel taking place and no tourism, what's going to happen to those second or third homes that were supposed to generate income?
Well, what's really interesting, the reason I remembered that was because I'm editing my book right now, which is due out in the summer, and I wrote it about this time last year, about in the spring of last year. So I start editing it, and then I go into the one chapter I have about real estate. And with the real estate chapter, I was really concentrating on, even though we had some bubbles in the United States, really the epicenter of these bubbles, two of the countries I saw was Australia and Canada, right, where the prices have just gone sky high. So when I reread it, I was like, I reread that study, and I looked into it again when I was editing, and I was like, yeah, so something like 1/3 of the homes that are owned in Toronto are actually second homes that are probably, been issued, or the bonds or the mortgages have been issued based on the down payment on the first homes, the equity in the first home. And And so those people are then using the income from the Airbnbs and the rentals to kind of pay the mortgage on both homes, or at least the mortgage on the second home if they have the first home paid off. So what's going to happen? All of a sudden there's no rentals, there's no travel, there's no tourism. So, and the economy is bad, so maybe if even their long-term rentals, people can afford the rental. So what's going to happen is those people are going to have to sell those second homes. And I think when that happens, probably, again, 6 to 12 months, I think right now people are getting those bailout checks and the deferments on the principal of the mortgages, so they can still kind of afford it. I think, but when that happens, and those people probably also think, again, this delusional thing I'm coming on to, that the economy is going to have a V bottom. When that doesn't happen, they'll be forced to sell, and you'll see them just and to sell those, and that could lead to kind of a trickle effect and a domino effect, where it's like, oh, I just had to sell my second home for half of what I thought I would get for it. I now got to sell my first home because I still got a mortgage on the second home, right? So that could lead to kind of some really ugly stuff going on in the Canadian market. And then also, if you do believe like me, a lot of the Canadian market was driven, we were talking about this off air as well, by a lot of Chinese money laundering and this kind of foreign money that was kind of parking in Canada, just because Canada's seen as like a stable country, et cetera, and overpaying for assets just because they want the money out. Well, what are the two main sources? Probably China and, the Middle East, like, oil money from Saudi Arabia, et cetera. Well, there ain't no oil money right now. And China is going to see a massive economic slowdown, especially as countries begin to pull out supply chains out of China and the whatnot. So all those Chinese billionaires who thought they were billionaires might not be billionaires anymore, and they may actually just sell those places to get some liquidity back. Like if you go look what happened in Toronto and New York in the early 90s, a lot of the Japanese billionaires, when their property bubble burst, had to sell in Toronto and New York, and that's why those two cities got really hit in the early 90s. They had to sell that just to bring some money back home, because all of a sudden they didn't have the money they thought in their own property bubble. So all of a sudden, of all these people who own, I don't know, like an export business in China, who's just been trying to get their money out, all of a sudden there's no exports. And they may have to just sell, and no one actually is looking into that sort of thing. Like, I know a lot of the people, like, I never believed in the Canadian real estate bubble, but a lot of the people I knew that did, that was one of their arguments, that this foreign money would always kind of come in. And then also, remember, there's going to be a backlash and kind of against the foreign money coming in, in a populist movement, because all of a sudden, if you got 25%, 20% unemployment, even liberals are going to say, hey, you can't be bringing in all these people in from China, the Middle East, etc., not because of anything to do with race, but just because, hey, we got to employ Canadians. We don't have enough jobs for ourselves. We can't be allowing all of this to occur. So I think it's kind of set up right now in terms of after this kind of what I'm calling the delusional phase right now is over, you're going to see this leg down. And then when you think about it, it is ridiculous. Like the average price of a house in Toronto is $1.5 million. In Vancouver is almost $2 million. Like, come on. Like, they're pretty nice cities. I've been there, but that's just insanity.
David, thank you so much for chatting with us.
Oh, thanks for having me.
My guest has been David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He also writes for the Financial Intelligence Report. Dave, do you have a title yet for the book that you plan to release this fall?
No, we got a working title, but I can tell you that if you type my name, David Skarica, on Amazon.com, you will see the tentative title come up, and you can pre-order the book, and they're due out like the end of July.
Thanks again for being on the show.
Thanks for having me.
If you have any questions for David or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.